JP Morgan is now warning that the U.S. economy has a more than 60% chance of falling into recession in the next 2 years. That number reaches more than 80% in the next 3 years, according to The Economist at JP Morgan. Joining us right now, the Wall Street Journal Global Economics editor, John Hilsenrath. And John, it is good to see you this morning. Thanks so much for being here. We've been talking about this narrative for a little while now. JP Morgan's not necessarily telling us anything that we haven't heard. My question to you is, do you think this is going to happen? And where do you see the triggers? Higher interest rates or something else?
Well, I mean, I think one of the triggers is fiscal. There's a lot of fiscal stimulus going into the economy right now. In addition to the tax cuts that we got last year, we have big increases in defense spending tied to that spending bill that got passed earlier this year. The biggest impetus from that fiscal stimulus is happening now. It wanes a little bit in the next couple of years, and that could slow growth down a little bit. Whether it pushes us into a recession, you know, I don't see the kind of excesses that we had before the last two recessions. So maybe it's just a slowdown.
Hey, John, that's bringing up a very salient point about, you know, the excesses of the last recession compared to what could happen in the next recession. And I think there's this misconception that all recessions are going to be like the last one, so deep, so severe, such dislocations that are happening in the market. But couldn't we have a recession that is really muted, given the fact that unemployment levels are where they are, historically low levels? If you look at it, it would be coming off a higher GDP print. It would be coming off of manufacturing that's doing so well, because that's what's a recession. It's just a drop in a lot of these economic numbers that come out.
Yeah. I will agree with you and disagree with you, two-sided economists. So, you know, it is true that we've had very mild recessions. You know, before the last one, the recession in 2001 was really modest. It lasted a couple quarters. There was very little drop in GDP. So you can certainly have a modest downturn. One thing to be cautious about the next time around, though, is that the policymakers in Washington here don't have a lot to fight the next downturn. So interest rates are already very low. The Fed can't cut them very far. They usually cut interest rates a lot during a downturn. You know, they're barely back to normal, so they can't cut them much. And as I was talking about fiscal policy, there's a lot of fiscal stimulus going into the system right now. We're running towards trillion-dollar deficits. The government is not going to be in a position to do a lot of tax cuts or a lot of spending increases next time around. So the shock absorbers that you get won't be very big, and that could add to the kind of downturn we get.
John, I'm interested in, I looked at the components of the JP Morgan model, and a lot of it had to do with sentiment, workforce participation. Yesterday, we had leading indicators come out that looked pretty good. All the sentiment indicators look incredibly strong. I'm wondering what the JP Morgan model looked like a year ago or 2 years ago. I mean, I wonder what the odds were of a recession going out 2 or 3 years if you kind of played it back, because I really don't see, according to what they're looking at, much cause for concern, and in fact, other economic models sort of echo that.
Yeah, and you know, the Wall Street Journal does a monthly forecast with economists, and we ask them every month what do they see as the probability of recession in the coming year. And you know, those probabilities were very low. They've been very low for the last several months. You know, I think the obvious risk to look at is on the trade front. Do trade tensions escalate? Does global trade start to wane, and does that hit U.S. growth? That's a possibility that I think we have to look out for.
But, John, it's Dagan. Therein lies, though, something that the administration could do if it looked like the economy was weakening even slightly, and that is ease up on the tariffs that they have in place. That means actually inking additional trade deals and opening up trade. So there are things within the government, not on the monetary policy side, that we could do potentially.
Well, they certainly could do things to ease tensions. I mean, lowering tariffs wouldn't necessarily be a direct stimulus to domestic growth. But I do think this administration's tactics have changed a little bit in the last 3 months. On the trade front, you know, they're trying to do deals now very actively. They got this Canada-Mexico deal inked, and they're going to try to get it through their legislators. It seems like the focus right now is on China and not so much these other fronts like Europe and cars and Canada and milk and all these other things.
But it would be stimulative if these tariffs are a headwind for businesses in this country,
right.
which we have heard about anecdotally. It would certainly help sentiment if you have
right.
some small manufacturers, mid-sized manufacturers in this country that are being hurt by these tariffs. Again, anecdotal, but covered in the Wall Street Journal. That's really what I was talking about. It's like there are some levers that this administration could pull other than just cutting taxes and cutting more regulations.
And we'll see. I mean, we haven't really seen a significant number of companies come out and say, look, these tariffs are going to hurt fourth quarter in 2019. Right. But now's the time. In the next couple of weeks, that's what we're on guard for.